If you own apartment buildings and lately find yourself asking, why does this feel harder, riskier, and less predictable than it used to be? You're not alone. More and more multifamily investors are realizing that owning real estate and managing real estate are two very different jobs. And while the equity may still be there, the headaches, the regulation, insurance costs, tenant risks have turned what was supposed to be passive into something much more difficult. I'm Kris German with The Apartment Dealer, and for the last 17 years, I work exclusively with apartment owners, not just helping them buy and sell properties, but helping them decide when it makes sense to keep pushing forward and when it makes sense to step out of the grind without stepping away from income or real estate altogether. Before we start, if you're serious about multifamily investing, subscribe to our channel, turn on notifications, and like this video. This content isn't for everyone, but it is for investors who want to stay ahead. In this session from our most recent Apartment Owners Educational Luncheon, you're going to hear from Warren Thomas, a CPA and managing partner at ExchangeRight, a national investment firm that oversees more than $6.7 billion in real estate and has helped thousands of investors make the transition from active ownership to passive, professionally managed income. Warren breaks down how seasoned apartment owners are using tools like 1031 and 1033 exchanges and Delaware Statutory Trusts to do three very specific things: eliminate day-to-day management, protect their equity from taxes, and replace unpredictable cash flow with consistent monthly income, all while staying invested in institutional quality type real estate. This conversation is especially important if you're asking yourself questions like, is it time to simplify? Is there a smarter way to stay invested without carrying the operational risk? And what does retiring from apartment ownership actually look like when done correctly? Now, let's jump in.
So my name is Warren Thomas. I am a managing member of a couple companies. One is called JRW Investments. At JRW Investments, we provide access to DSTs that are brought out around the country from real estate companies that are packaging particular types of real estate for the passive investor. So JRW established that in 2003. And we immediately became one of the leaders across the country in evaluating and bringing investors into the DST space. By background, I originally started as a CPA. Back in the day, I graduated in '78, so I'm the old man in our company now. And I ran as a tax practice in Pasadena for 25 years. In 2012, as the recession had been hitting and we saw the impact of the recession on real estate and on prior 1031 programs, whether they be oil and gas program, apartment program, net lease programs, all of the things that we had been evaluating. And I wanted to then create a more conservative approach, because the average investor that goes into a DST is a retiree or a pre-retiree. So I formed a company called ExchangeRight, and ExchangeRight now buys about $100 million of real estate every 45 days. And we buy it, we package them into net lease DSTs, and then we manage them on behalf of investors. So we have over 9,000 transactions, over $6.7 billion of real estate that we've acquired since 2012. So that's just a little bit about me. My background, I love this work. I love working with clients, and I love working with Kris and his team. From the standpoint of how you look at these programs, the DSTs, whether they're one of my programs or whether they're a program from any other DST sponsor around the country, they're all sold by prospectus, which means they call them PPMs, or private placement memorandums. And you want to make sure you understand that, and you thoroughly understand it, because you're going into a long-term, fairly illiquid investment. Okay, so we would go over that with you if you were coming into a particular program. Now, this is part of what Greg has already talked about, what is like kind and what is a 1031 exchange. As you can see, you can go from your rental property unit, and if you do a traditional sale, you're going to see, particularly in California, you're going to see a dilution of perhaps up to 42% of your income is going to taxes because you're subject to maximum state taxes is over 13%. And then you've got the federal tax at 20, depreciation recapture could add another 5%. And then there's this thing called investment income tax for gains over 250,000. So you'd lose a lot of money to taxes. If you do the 1031, you're getting all of that money working for you. You see in the picture there, a Kroger, Dollar General, and CVS. You can actually, as Greg was saying, you can get into net lease, but you can do it either individually by doing a traditional 1031 exchange into a CVS or into a Kroger, or you can do it in a DST format where you may have more than one property in the particular program. The next thing I wanted to hit was on 1033 exchanges. Again, Greg hit it a little bit, but what we're finding because of the fires, both in the Palisades and in Eaton Canyon and Altadena, we're finding that we're going to see a lot of what we call 1033 exchanges. The 1033 exchanges allow you to go from that property that has been destroyed and that you may have to abandon. You know, if you get a $2 million reimbursement from the insurance company and your cost basis was only $200,000, if you don't do something with that money, either replace that property or do a 1033 exchange, you're going to pay taxes on that $2 million or $1.8 million of it. So you can use a 1033 exchange. It mitigates the taxes just like a 1031. So this slide looks a lot like the last slide. But 1033 exchanges and under presidentially declared disaster areas like Altadena, you're going to have a 4-year period to replace and do your 1033. Okay? And many of you have lost properties up there. So this 1033 is something you might want to look at. Just be aware you want to rebuild your property or you want to do an exchange out of the property. Don't assume it's tax-free just because it was destroyed when you get that insurance money. From the standpoint of a DST, DSTs were originally formed in 2004 under a revenue ruling, and they are a fractional ownership structure, so you can buy a little piece. Sometimes people buy 15%, sometimes people buy 0.5%. The dollar amounts, whatever you need to do in your exchange, it probably would work. And then you can either do a diversified or a single property DST. You might find that a diversified DST might have 2 properties in it. It might have 30 properties in it. They are typically very income tax and estate tax friendly. They're going to qualify for the step up in tax basis upon death. They're also going to give you carryover depreciation. And there's ways to actually create new depreciation benefits by doing a DST. Okay, I already mentioned they're good for both 1031s and 1033s. The reason that investors like these, number one, tax deferral. Everybody wants to save the taxes. But number 2 is they want to preserve their capital, usually for the next generation. Out of my 9,000 transactions with our ExchangeRight company, our average investor age is 72.4 years old. It doesn't mean that we don't work with a 35-year-old occasionally, and it doesn't mean we don't work with a 94-year-old. But you can see that DSTs are most often used by a retiree or a pre-retiree, and they're looking for capital preservation, and so we're trying to create that opportunity for them. And then they're looking for stable income, something that can be almost like that Social Security benefit. I know some of you have been in the rental property business all your life, and that's all you've done, and you don't even qualify for Social Security. Well, you could use this to be the Social Security benefit that you otherwise wouldn't get. But they're all providing monthly income, very stable income. And then lastly, on this slide, you see strategic exits. So I'm going to illustrate that in just a minute. But traditionally, DSTs, these Delaware Statutory Trusts, had one exit choice. That exit choice was you hold it for 5 or 10 years, whatever the company has got in the business plan, and at the end of that 5 or 10 or 15 years, they sell the property and you do another 1031 exchange. That's the traditional DST exit. Since then, we've seen some changes. We now have 50% of the DST marketplace is selling a product, a DST, where they exit into the REIT of the company that's bringing out the DST. 50% of all the dollars that are going into DSTs these days go into that type of product. So you're going to find those products have been very popular because Morgan Stanley, Wells Advisors, Merrill Lynch, they've started to market those products. And so they're opening it up and they're marketing it to the same investor, but they're marketing it as a play that can transition wealth to the next generation. And they're trying to mitigate the risk. And they believe that by having that exit into a large REIT, that's a good way to mitigate risk. And I'm not here to argue that. Matter of fact, I've got a product that only exits in that way that we create. But strategic exits is important, and we tend to do more of giving you multiple exit options, which I'll talk about in a minute. Advantages, I've hit most of these already, but tax deferral, diversification. We had one investor that Kris introduced us to a year ago, and she had about $25 to $30 million of units, and she needed to diversify, and so she completed quite a number of transactions and was doing that to diversify and to create a steady, reliable cash flow. In this case, it was an older lady that no longer could manage the assets as well as she could years earlier. And she didn't have children that were able to also manage the properties. So she needed to do something different. I mentioned earlier, but the fourth bullet point there, you see new depreciation. Some investors come into a DST in order to create new depreciation. That needs to be carefully thought through, because if you sell your property for $2 million and you have no depreciation left, and let's just say you have no debt left on it because you paid off the mortgage 15 years ago, right? You can take that $2 million and maybe you find a DST that has 30 or 40% leverage. So your $2 million buys $3 or $4 million worth of property. You've just bought an extra $1 or $2 million that you can depreciate without actually having to sign on a loan. So some people try to use DSTs to create new depreciation, and it does work. You just got to make sure you're going into a DST that can handle the loan that is built into the DST. And then passive, I just mentioned that with this one lady. She needed to turn to passive ownership. And we also find a lot of investors that have a number of units, and then they come to us with one out of their 20 units to see what it's all about. And then the next year they might do another one, and they transition over time. Or they sell their pigs to us, or they end up going to the market on that unit that they did not like or that's causing them all the problem. And so they're selling it out in the marketplace. Contact Kris, get it sold for the best price, and do the 1031 and use that one as your first passive DST holding. The challenges with DSTs, number one challenge is illiquidity. You can always sell your rental property if you're willing to sell at the right price. But if you come into a DST, it's not going to sell until that asset sells by the DST company. So some DSTs have 5-year business plans. Others have 2-year. Others have 10-year. So you want to understand that, because during the hold period, it's an illiquid asset that you cannot sell. There's theoretically a secondary market, but you wouldn't want to have to go there, because if you did, you're probably going to lose some money on the way out. Also, DSTs, you need to watch out for your debt needs. I just gave you an example of somebody that is selling a property for $2 million that doesn't have any debt. If you're selling a property for $2 million, but you've got $1.3 million in debt, so your equity is just $700,000, then if you're going to do a DST, you need to look for a DST where you can use your $700,000 and take on $1.3 million in debt, because the IRS says you've got to replace the selling price of what you sold with that much value in the property you're buying. So you need to watch out for that on DSTs. A lot of our DSTs that we create are debt-free, and some of them have about 40 to 45 or 46% debt. And then no refinancing. Once you're in a DST, they do not do refinancing. And so if you go into a DST that has 5-year debt on it or 10-year debt, it has to go full cycle before that 5 years is up or that 10 years is up. Because DSTs are not generally, if you're going into a DST with debt, they're going to be shorter term holds, like 5-year or 10-year hold period, or shorter. And then you want to watch out for the costs of any DST. These are products that are sold through financial planning firms, and they're going to make a commission, or they're going to have an assets under management charged to you. And then the DST company itself is making some money by putting these together. Okay. And then you're also, the last bullet point is watch your underwriting assumption. Make sure that you've asked the questions of what do they anticipate the rent growth to be? What do they anticipate the expense growth to be? You know, what is the traffic count going by the buildings? All of that information is readily available. And if you're working with a good financial representatives, they're going to be asking those questions and helping you ask those questions. I'm just going to shift over and show you a quick example of one of the portfolios that we build. So this is what we call Net Lease Portfolio 63. And this was a $75 million equity raise, meaning money coming in from 1031 exchangers, but it's actually $125 million worth of property. And you see the names there. All of you have heard of this little company called FedEx, right? So FedEx, Tops, Dollar General, Tractor Supply, BioLife. These are typical names of what you might find in one of my DSTs. Now this is again the structure of this DST, 75 million of equity that was raised. It takes us about 45 to 65 days to raise 75 million of equity. Actually last month I raised 71 million in 1 month. So this one was a $75 million raise, 50 million of debt, 126 million, 125 million of property, and it was paying a 5% to the investors on whatever your money is that you're putting into the program. It had a loan to value then of 40%, so it would be used by those people that are either trying to create new depreciation or they had to replace their debt on their 1031 exchange. The average lease term without lease extensions was 12.4 years. And you can get into these with pretty much any dollar amount. Sometimes we have people bringing $14 million into one of these. Other times we have somebody bringing $68,000. So you can get into a DST with almost any dollar amount. We say 100,000 minimum, but you talk to me and I'll break that down. If you need 70,000, we'll do 70,000. This one had 15 properties in it in 15 different markets, 9 tenants, 6 industries, and diversified across 13 states. Under exits, I mentioned this already, but when you're looking at a DST, you want to know going in what the exit choices are likely to be. And so under number 63 portfolio, you could either do a 721 exit, that top line, where you exit into the REIT, and as code section 721 of the code, again, 50% of the DST market is going into programs that have only the choice of going to a REIT. This program had the choice. You could go to a REIT if you wanted to, when you determined to exit, or you could do another 1031 exchange, or you can cash out. We have 9,000 investors. We get about 10 to 11% that want to cash out, and almost every one of them is because either the husband or the wife have passed away during the hold period. They get a step up in basis, and it's the right time to cash out because now they don't owe any taxes, or the survivors or the estate don't owe any taxes on it. Okay, so you could do a 721, you can do a 1031 on the exit, or you can cash out. Under a 721, I'm going to just focus on this a little bit because you're going to hear about it from your Morgan Stanley broker or wherever your managed money people are. But a 721, it's a code section, and it allows investors to defer the taxes by contributing their DST interest into the bigger REIT. And you commonly call those an UPREIT transaction or an umbrella partnership. And they get you into a REIT where there are advantages, and the advantages include broad diversification across all the assets in the REIT. And you have to, and then that theoretically is mitigating your risk because you're in more locations, more credited tenants, if you will, perhaps better liquidity. Often they'll allow either monthly or quarterly liquidity. And instead of having to, cash in on your rental property for $2 million all at once, you could say, at the end of the quarter, give me an extra $80,000. Give me an extra 20 grand. You don't have to take it all at once. So the liquidity is a big feature. And then REITs tend to have better growth potential than a DST. Downside, if you're going to do a 721, you need to be aware that you can't do another 1031 in the future. So if you do a 1031 and you exit to 721, you cannot then do another 1031. You're pretty much in that REIT for a long time. Okay. And then if you have an excess of debt over basis, which is a technical thing, your CPA will know what I'm talking about, then we can allocate special debt to you so you don't have a taxable event in that. And then finally, 721 programs, they do vary widely as to both their size and their risk. So I'd be really careful. A lot of times we're seeing financial advisors that are trying to sell DSTs that are going into REITs, and they don't know a thing about DSTs. They don't know really anything about 1031s, and yet it's the product they have on their shelf. So you might consider working, if you're going to do a 1031 into a DST, you'll want to call somebody like our firm that does it all the time, and you want to make sure you understand the program. So our passion is to empower people to be secure, free, and generous, and we've been able to do that. And the net lease space has been a great space for us. We have bought, again, about $6.8 billion of real estate, and we've never had a missed rent payment. And it's because the tenants we buy are tenants like FedEx or Dollar General or BioLife Plasma, and their credit ratings are up here, and they'll always pay their bills. So thank you for listening. If you need me, I'll be in the back afterward. So thank you.
That was Warren Thomas walking through one of the more practical tools apartment owners are using today, the Delaware Statutory Trusts. For a lot of longtime owners, the issue isn't real estate itself. It's the management factor, the risk, and the constant rule changes that have turned what used to feel passive into a more full-time job. Most investors didn't buy apartments to spend the next decade chasing compliance, dealing with lawsuits, or worrying about what new regulation is coming next. A DST isn't about getting out of real estate. It's about changing how you participate. You stay invested, you keep income coming in, you preserve tax advantages, but you step away from day-to-day operations and management responsibilities. This is how many experienced investors transition from being operators to being owners only, collecting monthly income, deferring taxes, and letting professional teams handle the work. If you've built equity in your buildings and you're starting to think about reducing stress, protecting what you've earned, or creating more predictable income without the hands-on management, this is an option worth exploring. If you've built equity in your buildings and you're starting to think about reducing stress, protecting what you've earned, or creating more predictable income without the hands-on management, this is an option worth exploring. If you own here locally in Southern California, more specifically Los Angeles, San Bernardino, Riverside counties, my team and I would be happy to help you explore your options. If you found today's video helpful, give the video a like, subscribe to the channel, as we will be releasing the additional footage from our event in the coming days. Next, I would suggest you watch one of these videos here. And until next time, this is Kris German from The Apartment Dealer wishing you positive cash flow, tenants who behave, and much protection from Uncle Sam. Till next time.